Treasury Secretary Bessent, who is kind of leading the charge more or less on sort of explaining the economic policy. And, he basically is saying, look, what really matters here, and I think this is true in the near term, doesn't fix things in the long term. But he says in the near term, what we're focused on is he's got his 3-3-3 plan. Part of that is getting the deficit down to 3% of GDP. So currently it's at 7-ish or something like that, but he wants to get it down to 3% of GDP. And if he can, he said that actually solves a lot of our problem. It takes a lot of the pressure off, right? And you can get that down to 3% one of two ways. You can either grow the economy or you can cut fiscal spending. And they basically already said, well, we're not cutting fiscal spending materially anytime soon. So it's all going to come from growth. So that's why they're leaning so hard into, all the reforms that they're doing and the renewed trade deals and, potential tariff revenue that comes in with that and all sorts of things. I think if they're successful in that, then we may feel some lessened pressure in the near term, provided that nothing terrible happens. And of course, you and I know at some point in time, something unwanted is going to happen. We may have a natural garden variety recession, right? We might have something more than that. And then the question is, well, what's going to happen to the deficit as a percent of GDP then, right? And it'll probably slingshot right back to where it was, depending upon the new playbook and how bad that situation is and who's in power at the time. It could be way worse. Now that we've let the genie out of the bottle and we've started adding fiscal stimulus in conjunction with monetary stimulus during an economic rescue, who's to say that we just don't cut everybody even bigger checks next time? So I can believe them in the relatively near term that a lot of the things you're doing will probably goose this economy for some period of time. It'll feel better to more people than falling into a recession, right? So you'll probably get some nice kudos for that. And do I want the economy to grow? Yes, I do. But I think the way in which it's being pursued is not cure-all, and it doesn't solve the underlying issues, which is, at the end of the day, as we talked about, the deficit spending and the debt. And that, to me, is just a ticking time bomb ready to get, re-exploded the next time that we have, some sort of economic development that catches us by surprise or that we just can't work our way out of. Now, it's interesting. You mentioned a comment that I've heard many times over the years, and I've actually said it myself many times over the years, where you said, hey, maybe we need some deflation here. Like maybe we need a recession, right? A cleansing of the system. And I can definitely make the argument that while extremely painful, and I don't want to minimize vast amount of collateral damage that would happen during that time, that would be a good thing long term, right? To borrow another term from David Stockman, he talks about this period of increasing central planner intervention that we entered into, starting in the age of Greenspan, as the Great Deformation. And I think it's a great word for it. We have deformed natural market forces. We've stepped in to try to prevent them from happening and to try to engineer a different outcome than what reality wanted to have happen. And as a result, you break price discovery, you deform prices, you create this system that increasingly has to be propped up or rescued, or otherwise the natural forces want to create that clearing event and get back to a sustainable baseline. The problem is the more you deform it, the further away you get from that baseline. And if you were to correct to it, it's going to be an ever greater correction the further above it you get. So right now, nobody in power wants to have their name associated of having been in power when that big corrective event happened. Now, does that mean that we couldn't still have a recession that relieves some of the pain but doesn't fix everything? Absolutely. I think that's probably what we're more likely to get here. I don't know if we're necessarily going to get a recession. I used to think a year or two ago probability was higher. Now I'm a little bit less confident about it, but I can see us having increasingly anemic growth and it feeling like a recession for more and more people, unless and until we start seeing some of the benefits from these policies. Like I mentioned, that's kind of a midterm type of thing. And of course, if those don't show, then it's a different ballgame. So I agree with you there, but I just don't want to sugarcoat it. If we were to just literally have somebody in office to say, you know what, this has gotten way too distorted, let's just let it clear out, that would be a near nuclear event for far too many households than I think any politician would want to stomach. Now, that being said, and not trying to sound callous, the dust would settle, the sun would still come up the next day. There would be a lot of people who had lost their jobs or seen their portfolios get very damaged or whatever, but life would continue. And we could say, hey, you know what? We're now at a much more rational baseline where you can invest your money and not have to worry about a dramatic market pullback because the market's trying desperately to correct down to where it should be, where, we've cleared a lot of the bad debts. I mean, during big resets, a lot of bad debt just gets written off, right? So that could be a really healing process. It's just being realistic about it. As much as sort of rationally, I think we should do it. It would be so catastrophically painful. I just don't see anybody running the system being willing to let that happen. I personally think here that it is going to be much more home prices coming down than it is going to be wages going up, at least in the near term, to get the housing market sort of unstuck. For the past 2+ years, I've been sort of borrowing from the Game of Thrones and typing in supply is coming. We had this narrative that you and I have debunked in the past of housing inventory shortage. There's too few houses for home prices to come down, right? And I think there's a whole bunch of reasons to expect that inventory would start coming on this market as the market started to struggle. We've definitely seen that in more and more markets. So over time, I've changed that from supply is coming to supply is here to lower prices are coming. And now it's increasingly lower prices are here. So if you don't mind, let me just read you a couple of stats here. So housing inventory is now bounced back to pre-pandemic levels. So we are pretty close now to where listings were in June 2019. So before everything got really distorted and went bonkers during COVID, the inventory has been normalizing. This is from Lance Lambert. Amongst the 300 largest metro area housing markets, 110 of them are now seeing falling home prices on a year-over-year basis. So that's pretty big. We went from basically not seeing any for the past bunch of years, and everybody's saying, see, they can't go down. There's too few inventory. Now it's more than a third of them are down year over year. And really importantly, that's up from just 31 in January. With the larger institutions, it can be even worse. Some of these guys are deep-pocketed and can hold for the long haul, but a growing number of them, as they get more and more distressed, say, you know what, I got to get out of this. And they might have bought 1,000 units in the same MSA. So all of a sudden you have a market that doesn't have just 1 or 2 new homes come on, but might have dozens or hundreds, right? And as you know, housing's priced at the margin. You flood a market, the marginal price goes down pretty darn quickly. And what's interesting on the investing side is right now there's almost no spread between cap rates and the 10-year US Treasury. So as an investor, you want to get a return for the risk you're taking on, right? Like, okay, I could buy a Treasury bond and get 4-something%, or I could become a landlord and take on a whole bunch of additional risk. So I want to get a lot more than a treasury yield from this property. If the cap rates are low, I'm not going to buy this thing, right? Or I'm going to sell it. So you've got that going on. Then I think we've seen more bankruptcies, more corporate bankruptcies this year so far than any year in recent record. And so there's a real concern as companies have really stopped hiring that jobs aren't as dependable as they were. And that makes people really skittish. And that, either influences somebody to sell their house and get the getting while the getting's good. We're also starting to see front end of the bell curve of senior citizens that are now too old to stay in their homes. And so you're starting to see increasing forced selling based on that. So there's just a whole bunch of reasons why inventory is coming on. But I think what gives me the greatest confidence that we'll probably overshoot is that's how market corrections work. We see it in all sorts of markets, stocks, et cetera. Housing's no example. When the pendulum starts swinging, you swing from one extreme, you generally swing at another. So you pass through the mean on your way there. And I think that, we're getting close to the historic mean right now. I would be surprised if we just flatline there. I think we continue going while the housing market still continues to soften. Your question raises a couple of questions. One is, well, what's going to happen with financial assets? Are they just going to get goosed from here and get even, crazier? Maybe. The market tends to price in what it think is going to happen, and the market has priced in rate cuts for this year and for next year. So if the Fed starts cutting rates, you may actually not see much of a change in asset prices because the market is already anticipating. Now, if the Fed was to cut really aggressively, like if the Fed was to go from 4 down to 1, then yes, they would definitely move. Although in that case, just to be clear, asset prices might go down because they're thinking, oh my God, if the Fed is cutting that significantly here, they're freaked out about something and it might actually end up spooking the markets. But in theory, over time, if the Fed engaged in a long-term rate cutting and got us back to the 1% era, that would generally be supportive of asset prices. I don't necessarily think we're going to get there. I think there's a lot of constraints to that happening as much as Trump would like to see it. And Trump's the kind of guy that puts the anchor way out here and then usually strikes a deal somewhere in the middle. So maybe he'd be just fine with something in the low 3s, but he's putting 1 out there just to get everybody all hot and bothered about it. Who knows? But to your larger question, I think we're in for a rocky next 6 to 9 months. I do think the odds aren't bad that things pick up for a bit after that. But in the long term, what I'm worried about, which I think we're taking this there with your question, is kind of like, where does this all end up? If we continue with efforts to, goose corporate profits, but also try to manipulate the cost of money so that asset prices, continue to get elevated. And we're investing in technologies that really favor the parties that own the technology and disfavor those who are in competition with it, which in this case is laborers, both blue collar and white collar, that's where we end up in my I-shaped economy that I'm so worried about, which is, yeah, I can see over the long term that asset prices continue to rise, right? And we already know that was 93% of all financial assets are owned by the top 10% of households, right? I think that concentration is going to continue, right? So those who own the assets and those who own the means of production, I think will do just great. And they're going to be that little dot up in their little, Elysium by themselves. And it's everybody else who increasingly gets left behind that is going to have vastly diminished prospects unless we take a different tack than we're taking right now. And the AI folks, look, I'm not anti-AI. I think there's a lot of great benefits it'll bring to society, but I think we have to be much more planful than we are right now in how we're executing on it. And when you talk to the big AI fans and you really poke at like, well, what happened? A lot of them say, well, this isn't going to displace jobs. I'm not convinced of that. I do agree that it will create jobs in the near term in the trades, right, as we build out all this new infrastructure. But as we're already seeing in a growing number of companies, there are software programmers that are recruited to build AI tools. And then once the AI tools are built, they fire the programmers that built them because they don't need them anymore, right? We're going to see that just all over the economy. And so I think we end up in a place here where there's just a truckload of people that are displaced. And so the AI folks say, yeah, okay, but then we'll have universal basic income. You know what? We will take some of these corporate profits and we will, fund people's essentials, and you'll be able to stay at home and learn anything you want and, use this time to find your best self. And we just know that humans do not do well with that, both culturally and just economically. We've actually seen this during COVID. What happens when you give people free money? Well, they rush out to spend it, and then prices go up as much as you gave new money into the system, right? So you immediately get inflation that negates the benefit of the UBI check that you're giving people. So even economically, it doesn't work convincingly.